Hello, Doctor. Our group going to do our group presentation. Our group has choose ISH, Alien Bank, and IOI property. Before I start my presentation, let me introduce our group member. I am Tan Ching Hong, group member Chui Siping, Ija Singh, and Huai. IHS has operated 37 private hospitals in 10 countries, including China and India. There are more than 60 beds in their facility. The company is headquartered in Malaysia and also considers Singapore and Turkey as their home market. Alliance Bank. Alliance Bank is a banking group that provides banking and financial service to the consumer banking, commercial banking, Islamic banking, investment banking, and stock brokerage business as well as unit trust and asset management. This bank has contributed more than 50 years of proud history to the Malaysian financial industry, committed to providing the best customer experience and creating long-term shareholder value. IOI Property. IOI Property was recognized as one of the top 10 developers in Malaysia. It is known for creating sustainable and closely connected modern communities such as IOI Reserve City. They are also constantly exploring opportunities to strengthen connection with the community and their customer. Based on the data have given, we are using the formula which is beta equal to covariance divided by variance. So this is the data result that we can get. So beta coefficient for ISS is 0.03289, Alliance Bank is 0.09179, and IOI property is 0.9189. So I will pass my group member to present this slide.
I'm going to talk about the required rate of return of the stocks. So next slide, please. There are two questions about this one. So the first one use the CAPM method to determine the required rate of return. Next slide, please. The capital asset pricing model links the non-dispersible risk with the expected rate of return. In its formula, we mainly need to solve the three aspects. The first one is related to beta coefficient, and we have obtained the beta coefficient of three stocks. The second is risk-free rate of return, which is necessary rate of return of risk-free assets. The third is risk premium, which is difference between the expected market return of the stock and the risk-free rate of return. Because risk premium is called market risk premium, it means the premium investors will get when they bear the average risk of holding market portfolio. In order to calculate the required rate of return for three stocks, Alliance, IHH, and IOI, we use capital asset pricing model. Next slide, please. This one is like Malaysia 10-year bond yield. So for the expected market return of stock, we can refer to the date FBMKLCI, and the selected time range is from January 2nd, 2020 to June 14, 2021. According to the figures in the table, Tan, can you go back to the slide? Yeah, the date of second day minus the date of first day, using the result divided by the date of the first day to get the market return of that day. If we calculate all the data, so we will find that there are 353 dates in total, and then divided by 353, we can get the average market rate of return, which is 0.01062%. According to the calculation of the risk-free rate of return, we can refer to the Malaysia 10-year bond rate data. We can be found in the investing website. Collects the interest rate or date of Malaysia 10-year bond in the same period, and they take the average date. Represent the risk-free rate of return is about 2.94%. Next slide, please. Next slide. For this one, we're going to talk about the treasure of 10-year bond as the free risk return. So with regard to the required rate of return for the islands, we have already known the beta coefficient of islands, the risk-free rate of return and the risk premium. On the basis of formula of the capital asset price model, which we can calculate the required rate of return, is about like 2.67%. The same approach can be used in IHH of the required rate of return. In the capital asset price model, the most difficult to calculate is the beta coefficient, but investors still believe that portfolio with large beta value will be more valid than the market price. Whether the market price is rising or falling, the change of the stock portfolio with smaller beta value is smaller than the function of the market. No information has come to a conclusion that we can calculate the required rate of return for IHH is about 2.84%. We can easily analyze the required rate of return in the first two stocks. CAPM module has been widely accepted by many people. Different people can use this method according to the different purpose. However, the model mainly analyzes the sensitivity of the security return and the market portfolio return and doesn't consider other factors. The same situation applies to the IOI of the required rate of return is about 2.67%. Based on the data provided, we have already got the risk-free rate of return and the risk premium. CAPM gives a very simple conclusion. There's only one reason why investors will get higher returns, that is to invest in high-risk stocks. There's no doubt that this model plays a leading role in modern financial theory. Under the same conditions, the higher the beta coefficient, the higher the required rate of return, and the lower the beta coefficient, the lower the required rate of return. Because when market price fall, they can invest in stocks with lower beta values. When the market goes up, they can invest in stocks with beta value greater than 1. So give to my next group member, Jiaxin.
Hello everyone. Earning per share, also known as after-tax profit, and earning per share refers to the ratio of after-tax profit to total share capital is the enterprise net profit that common stockholders can enjoy or bear for every share. Earning per share is usually used to reflect the operating result of enterprises, measure the profit level and the investment risk of common stocks, and it is one of the important financial indicators for investors and other information users to evaluate the profitability of enterprises, predict the growth potential of enterprises, and then make relevant economic decisions. Calculation formula. The calculation formula of basic earning per share is as follows. Basic earning per share equal current net profit attributable to ordinary shareholders divided by weighted average number of common stocks issued in the current period. Usage method of earnings per share growth rate index. Firstly, the company's earnings per share growth rate in the comparison of the whole market, and then comparison with other companies in the same industry, and comparison with the company's own historical earning per share growth rate. And last, measure the future growth potential of the company by comparing the growth rate of earnings per share with the growth rate of sales revenue. And then calculation EPS of islands, IOI, and IHH. The growth rate of a stock can be used by identifying earning per share or dividends of a company. Since EPS is the amount of income that belongs to each share of common stock, an investor uses EPS to determine the value of a stock. We must find out the amount of its EPS and its dividend for several days from 22nd January until 14th on June in next year. The data on table has showed that the EPS for islands that refer to given table than the stock analyst can do for EPS calculation each day. The formula that can be used to identify the island's EPS growth. The relevant data is shown as follows. EPS equal dividend first, then minus dividend 0, then divided by the price of stock of the last day, and the EPS growth equal EPS second day divided by EPS first day, then minus 1. So the EPS growth rate of islands is average of EPS growth of every day, which can be calculated as 0.158%, and by the same way, we can get the EPS growth rate of IHH as 0.0115% and IOI as 0.387%. Thank you.
Okay, thank you, Yazin. So here is a conclusion. The stocks have a positive number of a correlation with the KLCI or the market. It means the relationship between the two stocks are aligned. It means if the price of KLCI or market as a whole is increased, all these stocks' price will also move in a positive direction. Based on our calculation, our beta for IHH is 0.03289, for IOI is 0.09189, and for Allianz Bank is 0.0919179. So it means that the beta stock of IHH, Allianz Bank, and IOI property are systematic risk or underperform. If the investors are risk averse, they must avoid IOI stock because IOI has the highest beta. The higher the beta, the higher the risk. So that's for beta. For required rate of return, IOI and Allianz Bank are give the same required rate of return, which is 2.67. And for IHH Healthcare give the highest required rate of return with 2.84. The higher return may due to during pandemic there is a lot of activities and sales in healthcare. So the last one is EPS growth. EPS growth for IHH is 0.0115. For IOI is 0.0387, and for Allianz Bank is 0.0158. So if the investors are interested in high growth stocks, then they should invest IOI stock because IOI give the highest EPS growth at 0.0387. while IHH gives the lowest EPS growth at 0.0115. So in addition, if the investors are risk averse, they should invest in IHH stock because IHH is the lowest risk. So that's all from our group. Thank you.